Welcome back to another episode of What's on Your Mind. I'm Chris Quill, and I'm delighted today to have Jason McDonald and Anthony Iser joining me on the show. Gents, always a pleasure to have you guys on. Now we're going to get straight into it this week, and we'll talk a bit about what you guys are thinking about markets and also ideas that might fit in your own portfolio. So with that being said, Anthony, let's go over to you first, and you can kick things off for us.
Thank you, Chris, and hello, Jason. Delighted to be here with both of you again, and hello to all the viewers out there. I've got a couple of things I'm going to talk about. I've got some thematic ideas, but I'm saving those for our end-of-year conference coming up this weekend. So I'm going to talk about one buy idea that I like the look of, which is pretty tricky in this market at the moment when we've got so much selling pressure and so much negative news. So the company is called Wingstop. If you're in the UK and the US and perhaps Singapore and Canada, you might have come across one of their stores. Basically, it is chicken. It's wings, needless to say. It's a $2.25 billion company. There's a little bit of short interest out there, about 10% currently. But what I like about this is in this environment, it looks like margins potentially can be quite stable and continuing to get this top line growth. So as I said, and the name suggests, chicken wings is their thing. They've got 1,700 stores, growing at a couple of hundred a year around the world. And most importantly, one of the key metrics for anything in retail that I would look at is same-store sales growth. And they've had 18 years in a row of same-store sales growth. And that's even during COVID. It's even during the global financial crisis. So it's a pretty stellar record, just year after year. Shows the resilience of their model. So what is their model? They've got three divisions. 44% comes from royalty and franchises. So these are predominantly franchise stores. They get 30% coming through from advertising fees, and about a quarter comes through from their own company-owned stores. The returns for a franchisee are pretty good, 70% cash on cash, unlevered returns. So they've clearly got a good business model. It's about finding locations and about how quickly they can expand. Last quarter, things were really good. System-wide sales up 12.5%. They opened 60 new stores. They had 1.2% same-store sales increase. They're really driving digital sales. So a couple of the big things that all these types of fast food outlets have realised over the last couple of years, COVID's driven it, is that digital sales and deliveries are much higher margin. And if they could do all their business that way, they probably would. Now, a McDonald's is still going to have in-store dining. The nature of these stores is they could potentially move to almost all delivery and digital sales with very limited in-store dining, and that's many of their stores have that at the moment. So total sales up 7.8%, and the digital sales that I mentioned up 62%. Sorry, not up 62%. 62% of sales were digital. Looking forward, one of the things that I like is the top line growth looks pretty solid. We've got that same store sales growth. We've got continued store rollouts, the 60 in the last quarter, looking at a bit more than 200 for the year. So forecast for the next 3 years is about 24, 17 and 16% growth at the top line. Now, in this market, margins are a big issue. What's going on with costs? And these guys are holding in there pretty well. Labor isn't a huge cost for them. Chicken is down, costing about $1.60 a pound. They've got a range of things they're working in place to keep that number around there, certainly under $2 a pound. It was back up above $3.21 a pound coming out of COVID in sort of 2021. So looks like costs are going to be largely under control. They don't have huge transportation costs. So the EPS line is also growing pretty solidly, 14, 22 and 25% for the next 3 years. The stock's trading around $75. That's down from a record about $172 as a high. It is a function of what we've seen in the market across the board since November. Multiple contraction. So PE's gone from 114 down to 46. Price to sales was 17.5. It's down to 6. And those sales numbers, as I said, continuing to go up. Earnings going up. We have seen a slight downgrade in expectations in the last quarter, but I don't expect that to continue. So I'm going to keep this one super simple. It's chicken wings. The costs are down about $1.60 a pound. They should be able to keep those other costs under control. With the top line growing, we're going to see margin expansion. Digital sales, delivery sales are going gangbusters. So it's a pretty simple story in what is a very sort of tough market at the moment. And it's not as a strongly discretionary item. The pricing here is not large. It's not a decision where someone's making, do I buy a new washing machine? Do I buy a new house? Do I buy a new car? $5, $10 for chicken wings is not going to be that marginal decision at this point in time, I think. So I would look to structure this around the next result, where I would anticipate they'll continue with those same store sales growth and keep costs under control. So buying $75 calls for about $8. I'd sell the July 75s for about $5 and do that in a 2-for-1 ratio. Ideally, stock just travels sideways for the next little while. Those July ones drop out, and then we can look for a strong result in early August. So tough to find them at the moment, I think, but there's a buy idea that I really like the look of.
Yeah, I agree. Definitely hard to find some buy ideas, but that one sounds fantastic. So thanks for that, Anthony. Jason, let's go over to you.
Yeah, thank you. So I've got a short idea, company that most people will have heard of, called Moodys, which is the rating agency. So ticker's MCO, market cap around $47 billion. Share price closed last night at $260. So, what do they do? Pretty simple to understand. So they obviously provide credit ratings, research, and things like sort of software solutions, risk management services, credit assessment services, credit process software, basically to banks and other financial institutions. The way they report is they've got 2 operating divisions. The one that we're probably all familiar with, Moodys Investors Service, or MIS, which last year was 61% of revenues, but importantly, 80% of total operating income. And that's the credit ratings business, where they're researching debt instruments and securities. So they've broken that particular segment up into structured finance, corporate finance, financial institutions, and public project and infrastructure finance. And then the other reporting segment is Moodys Analytics, which was just shy of 39% of revenues last year. Now, this is actually where the growth has been coming from historically, but it's still only 20% of total operating income. And what they've got in there is basically financial risk management solutions for mainly financial institutions. They've got 3 lines of business in there: decision solutions, which is essentially software, and they've got research insights, which basically is like a modeling sort of data information business. And then the last business is essentially a data business, where they're providing very large data sets on things like economies, companies, and financial securities. So, as I mentioned, the growth has been in the smaller side of the business, where they've been acquiring quite a bit over the last few years. In terms of the overall industry picture, we've probably all heard of S&P as well, and Fitch. Basically, this is a duopoly between Moody's and the S&P. So Fitch is really like quite a distant third placed company. So it's really a Moody's and an S&P story. In terms of the quants, so for this year, 2022, the analysts are penciling in an earnings drop of 15%, and then rebounding next year with EPS growth of 16.5%. For this year, the company's on 24.4 times PE, and for next year on 21 times. Now that compares to, in terms of the sector, which clearly is just them and the S&P, where the average earnings drop is going to be 11.5%. So in other words, Moodys earnings are dropping more than S&P this year, according to the analysts. And then again, a rebound next year on the kind of sectoral level of 18% in earnings. PE ratios average 25.5 for the sector and 21.4 for next year. So the company, clearly has got a worse earnings outlook and is on a slightly discounted PE ratio compared to S&P. In terms of the other metrics, got a very small dividend yield, 1.1%. Virtually no short interest. It's just under 2%, and days to cover just under 3 days. So in other words, this is not really what you call a consensual short. So what's behind the idea? Well, point number one, no prizes for guessing that this year total US fixed income issuance is down quite a lot. It's down 25%. Within that, you've got things like MBS issuance, so mortgage-backed securities, down 45%. Corporate bonds issuance down 23%, but basically every single category within US fixed income is down in terms of issuance. What we're seeing here is, as we've been speaking about quite a lot over the last few weeks, is everything is getting repriced in terms of now the new QT, quantitative tightening backdrop. What this implies is that there's going to be less market access for a lot of issuers, and that means that there's less raw material for these guys, Moodys and S&P, to rate, quite simply. Secondly, also what we've seen particularly over the last 5 or 6 years, is the rise of the private credit market. So in other words, credit which doesn't need and doesn't receive a rating. So particularly private equity firms have been bypassing leverage loans which are rated and instead are using private debt or private credit which is not rated. To give you an idea of the kind of quantum there, in the last 5 years, global private credit assets under management have doubled to $1.2 trillion. Again, this is kind of, that side of the business is just not anything that Moodys will be exposed to. Thirdly, if we think about it, we're basically at the end of a 40-year bull market in bonds. And, if we are going to experience a prolonged bear market in bonds, then of course that is going to affect growth of bond rating businesses, which I'm not sure that is fully priced in yet. Fourthly, if as we see has already started, if it continues that essentially debt markets are closed for the time being to highly levered and often barely profitable borrowers, then this could kind of be signaling a multi-year decrease in revenues and earnings for the bond rating guys. And I don't think that is factored in to the estimates that the analysts have got. As I mentioned at the beginning, they've got a drop in earnings this year and then a quick bounce back next year. And then after that, record EPS again, which I think is slightly unrealistic. And we've already seen S&P Global have already suspended their financial year guidance for this year, and that's basically, as they said, based on a large decrease in credit issuance. So I'm kind of wondering, how long is it before Moodys has to do the same thing? And then in terms of the latest data that we're seeing, according to Bloomberg, last week, precisely zero US high-grade corporate bonds came to market, and basically at least 6 issuers pulled their debt offerings. That's the first time this year that investment-grade firms were completely kind of closed out of the primary market. We're seeing, a similar lack of activity in the state and the muni debt market, which has also massively slowed. So last week we had issuance of $2.4 billion of new supply, which was the slowest week since January. And in fact, we saw in the middle of last week on Wednesday outflows from municipal mutual funds of 5.6 billion, which is the third worst one-day showing on record. In terms of the last earnings report, which was for Q1 on May the 2nd, they had a small EPS miss, small revenue beat. So adjusted EPS of $2.89 versus consensus of $2.91. That was a drop of 29% year on year. And revenues came in slightly ahead of consensus at 1.52 billion, which itself was also a drop of 5% year on year. Now, in terms of the catalysts that I'm looking for to make this thing work, well, as I already said, on June the 6th, S&P Global suspended their full-year guidance based on dropping credit issuance volumes. So I'm expecting maybe a similar thing with Moodys. We've currently got, in terms of the analyst community, we've got 11 buys and strong buys on the company and 7 holds, only 1 sell. So I think you could see some downgrades on recommendations there. And likewise, I'm looking for EPS and revenue downgrades, which could come as early as the beginning of August, which is when the next earnings are due. Now, the tricky aspect, this market is up and down at the moment. And, we saw quite a big rally yesterday, and already futures are kind of indicating half of that being given back pre-market. So in other words, we're in a very up and down market. Volatility isn't outrageous, but it's definitely, elevated higher than it was. So in terms of the stock price here, with anything that we trade, we need to be very price sensitive and we need to pick our moments. So at this moment in time, even with a small rally in the stock yesterday, it's currently technically a little bit oversold. So what I'm looking for is a further rally, hopefully, in the stock price that I can then sell into. And at that point, I'll assess the trade structure. This is a massively liquid name. It's a $47 billion market cap. So I'll probably end up doing a combination of stock and options, obviously puts, looking at put spreads and possibly calendar spreads. But it will have to be decided at the time when, the price is right, as it were. So at this moment in time, I'm kind of on the sidelines, basically waiting for a good opportunity to short that.
Great stuff. Thanks for that, Jason. I think it's an interesting point that you bring up, that you have to be more price sensitive when there's more vol as well. That's a good lesson for everyone to take away, I think. Anthony, let's go back to you. What have you got for us?
Well, I've also got a short, Chris, and it's worth noting, as Jason pointed out, yesterday was a pretty strong day, where this is pre-market on Wednesday. So Tuesday, strong day, everything was up pretty aggressively. This is a company that I think the outlook, it has to be significantly more negative than is being priced in now. So I am looking at shorting Dillard's. Now, Dillard's is a big department store conglomerate, family owned predominantly, founded about 80 years ago. The family is still president. The family is still CEO. They've got 280 stores across the US. Now, in most parts of the world, department stores have largely shut their doors. Macy's went into Chapter 11 during COVID. It's back, but under pressure. To me, this is a segment that is really going to struggle in a tougher economic climate, which the US is facing now. So the stock's trading at $275, $276. It's about a $5 billion market cap. Like I said, it's run by the family. They predominantly, they own a bulk of the shares. There's not a lot of information out there. They don't bother doing investor calls. They don't put out presentations. So there's not likely to be a lot of new buyers or people sitting there who have looked at this company in any big way, met them on an institutional level and thinking, I might step in if this comes back. So the stock, as I said, $276 at the moment. Pre-COVID, for the bulk of the years through to 2019, the stock traded in a range around about $65, 65, 75 max for a long time. Got down to 20 during COVID and rallied out of COVID to a high of nearly $400. So department stores, we've all been in them. This one is more focused on apparel. Often they'll have sporting goods and homewares. We've got 14% cosmetic sales here. 36% is coming from ladies' apparel and accessories, 11% kids, 19% men's, 15% shoes across the board, and that's 95% of their sales. So it's basically clothes. There is a little bit of homeware going on, but there's no sporting goods. It's not this sort of broad general department store that we often see. One of the issues they've got that I think is going to unfold in this quarter as well is that they've got a big private label merchandise offering, the bulk of which comes from China. So how have they been going? How did they get to a 400 share price, and why are they at 276 now? Basically, things have been going incredibly well for them. Retail sales trend up 23%, gross margin 22%, gross margin 46%. Store counts down slightly, 280. They've trimmed one, but their sales per square foot, another very important measure for retail outlets, up from $28 to $34 per square foot. And the inventory increased just slightly, 4% in the last quarter. So essentially, things are going well, record margins. And that's one of the issues that I have. In this environment, I don't think those record margins can remain. So again, looking back to pre-COVID into sort of a normalized period, their gross margin was around 33, 34%. Their net income margin was under 3%, which is very common for these types of retailers. These are tough businesses that are facing massive competition from specialist retailers and groups like Amazon, of course. During COVID, those numbers dropped from mid-30s down to 30 for gross margin, under 3 down to a loss of sort of 1.5% at the net margin line. But they've recovered strongly. 47% record margins in the last quarter at the gross margin line, almost 14% at the net margin line. So up massively from the 2.5% to 3% that it had traded at beforehand. So to me, this is a call that's largely driven by the macro, which will then flow through to the stock level. So we've got weakening retail sales. Department stores within retail sales has largely been flat. So the growth that Dillard's has been an outlier, and I don't think that can remain. Obviously, we just saw 75 basis points at the last Fed meeting. We're going to see more. The impacts are flowing through across the board on the consumer side. And the fourth point on this is, the third point is that supply chain remains a massive issue. They talk about it. They get lots of their goods from China. You've got supply chain issues all across the US as well, at ports with trucking. There's a real risk that there's no sort of improvement in that over the summer. And then the fourth point on this is that there's inventory risk as well. So we recently saw Target and Walmart find themselves stuck with inventory, having to cut prices to try and clear that merchandise. Now, for these guys, that could go either way. Because they get a lot of their inventory from China, there's potential that their inventory levels might not be too high simply because they couldn't get it. But the opposite of impact of that potentially is that the volume numbers will decline. So what am I looking for here? The key thing is I'm looking for margin decline. I'm looking for reversion to the mean, which is not my preferred sort of investment or trading style. But in this case, I think these numbers are just way too high and they need to come back down. as I said, the margins have been spectacular, 47% last quarter, 23% same-store sales. Now, the company puts this down to their ability to control inventory and the very positive response they've got from their merchandise. A more cynical view would be that this has been massive stimulus for the last 2 years, and that has driven their ability to maintain prices as people spent. And that, to me, is coming to an end. So the information, as I said, fairly limited. They don't break out sales. They don't break out online numbers. We've got those divisions that I mentioned earlier, and that's about it. But when we look at the forecasts, we get a picture that tells me there's still plenty of risk to the downside, and mostly coming from margin squeeze. So mostly at the earnings line. So sales numbers forecast to be flat this year, down 2% next year, and 11% in 2026. Their sales number hasn't really changed. It's coming in around about the $6.5 billion. That's what it was pre-COVID, and that's what it was sort of year after year in the years prior to that. What's been the big kicker is all the lines below that. So those gross margins expanded, net margins expanded, and profits grew dramatically. But we've got declines coming through now as they face these increased costs. Decline of 30% next year and 26% after that. It shows the extreme sort of levels of operating leverage that they've got here. So if they face a hit to that top line, those numbers can come down a lot further than that. And that's what I would be expecting as they face weaker demand, as well as the need to cut costs. To the need to cut pricing to clear merchandise. So there's a whole bunch of risks in the world at the moment. We know most of them, and they impact all sorts of industries. In their last quarterly report, they did talk about these risks, which include obviously wars in Ukraine, COVID and China's policy to that, shipping costs, shipping capacity, tight labour markets, port slowdowns, trucking issues. So they spoke about these, and then they concluded that the extent of the impact is going to be determined by our customers' ability and willingness to accept price increases and our ability to receive merchandise in a timely manner. And that there sums up where I think the risks lie and why there's an opportunity here. So, again, if we look back to those pre-COVID periods where it was what I would consider to be their normalised returns. Gross margins were low 30s, net margins under 3. I think we're going to see that unwind in a big way. And the key factor there is their customers' ability and willingness to pay higher prices. We've already seen it in housing markets coming through. We've seen it coming through from Target, from Walmart, from a range of retail outlets where people are no longer willing to accept higher prices. They're looking for cheaper alternatives. They're moving down the chain towards lower cost retailers. They're finding alternatives, or they're simply not purchasing. So I think we're going to see an issue where the two components of their top line get impacted. The sales price comes down and the volumes come down, leading to a cascading effect to the bottom line. So what have we got coming up in terms of catalysts, and how would I be looking at playing this? We've got retail sales on the 15th of July, and then the next earnings result is August. And that is where I would expect them to come out and say, this period for May, for April, May and June has been particularly negative, and see these downgrades coming through and a significant re-rating downwards. So trade structure. I'm looking at a put spread here, but a slightly different one from usual. So I want to buy the 270 puts, which are around about sort of at the money for August, to take advantage of the catalyst in the earnings result. I would sell the July 250 puts, so a little bit out of the money, giving myself a little bit of leeway. And hopefully there might be a little sort of market rally and we can sort of close out those ones early. Buy them for 30, sell for 9 in a 2-for-1 ratio. But I was also looking at it, and in the options chains at the moment, the August 350 calls are selling for about $12. Now, 350 from 270, you're near enough to 30% above this current price. So I'm turning it into almost like a sort of synthetic short, and I'm going to sell those as well for $12. So my net outlay is going to be about $14.50. Now, I do have risk above $350 a share. If this goes back to record highs at $400, then I'm going to be a little bit underwater. But we're talking about potential recessions here, that we're oscillating between a recession is guaranteed and a recession is 50, 60, 70%. In this environment, I just don't see a department store retailer going up 30%. So despite having that risk there, I don't think it's particularly high and something that I'm willing to take on. So there we have it. Dillard's, margin squeeze, retailer, department stores, which I think inevitably are going to be shutting up shop over the next decade anyway. They have in most markets, and this may be the impetus if we do see a recession to drive that.
Great stuff. Thanks for that, Anthony. We'll go back to you again, Jason. Have you got any more ideas or any sort of market macro commentary you wanted to touch on?
Yeah, I got a few general comments ahead of the Q2 earnings season that obviously starts next month. I mean, I could not agree more with what Anthony's just been saying with respect to Dillard's. I noticed, so even though Q2 is coming up really next month, Kroger, which is the fourth largest grocery chain in the US, they actually reported last week, and they are, guess what, seeing declining gross margins. So their margins fell from 21.9%, this is on gross margins, to 21.6%. Okay, you might say it's only a fall of 30 basis points, but the street was expecting an increase to 22%. As usual, it's supply chain problems and what they call strategic price investments, which clearly is just them slashing prices. We've also had basically a currency-related profits warning from Microsoft because of US dollar strength, and Anthony mentioned it as well. We've had Target slashing their guidance twice in 3 weeks because of increasing inventories. So, I'm definitely not as optimistic as the analysts seem to be on either earnings or margins. To put that into some kind of quantitative framework, from a bottom-up perspective, as of 2 weeks ago, a company called FactSet, basically putting all the bottom-up analyst estimates together, it looks like the street is expecting in Q2 a 4% year-on-year growth rate in earnings. Now that's down from 6% estimated at the end of March. However, what I found really a bit confusing was that expectations for the second half of this year have actually been rising. So the sell side is now looking at 9.6% full year earnings growth for the S&P across this year, compared to 8.8% in April and 8.4% at the start of the year. Now, I'd say that is optimistic, to say the least. We've talked about it kind of ad nauseam, but I do think that the Fed, there is a risk there that they are going to over tighten into possibly a recession, and that definitely, as Anthony's been pointing out, profit margins are at risk here. If we look at the aggregate, the analysts seem to think that S&P 500 net profit margins will be around 12.4% this year. Now, okay, that's down from 13.5% Q3 last year, 13.4% Q4 last year. But, Anthony was talking about reversion to the mean here. The average for net profit margins going back to 1993 is 8.2%. So please let me repeat that. We're talking about analysts expecting 12.4% compared to an average going back to 1993 of 8.2%. In other words, we are at historically high net profit margins, and it is difficult to see those margins going up. It's very clear that corporate America is having an issue passing on rising costs. And if we look at things like the PPI, so the Producer Price Index, that's up 9.4% in the last 12 months compared to 6.7% on CPI. Now, to put that into perspective, in the decade leading up to last year, PPI rose by 1.6% on average compared to 2.1% in CPI. So we're seeing massively elevated numbers. And in the other, in the other sense, in other words, that PPI is much higher than CPI, I just don't see these margins being maintained. And that really feeds into, what Anthony's been saying there with Dillard's.
That's a really interesting way to frame it, sort of PPI versus CPI relating to profit margins. So thanks for that, Jason. Guys, it's been a pleasure this week, as always. Some great ideas from you both, so I appreciate you both kind of taking the time today to come on the show. And for all of you watching, I hope you guys enjoyed that one as much as I did. There was lots of lessons to take away. And what I would say to you is, why stop there? We've got plenty more to offer you guys in terms of education through our website, itpm.com. We've got courses, we've got mentoring programs, and we've also got some webinars coming up through July as well. On the 8th of July, we have a special public webinar, so open to the general public, where we have an ITPM trader and student, Stefan, coming on to talk about how successfully he's traded the recent bear market. Then we've got another one on the 16th of July called Hunting for Bear Market Trade Ideas. That's with Anthony Iser here, and that promises to be full of pertinent information given the current sort of market environment that we find ourselves in. But with that being said, I'm going to close the episode here. I hope you guys all enjoyed this show today, and make sure you catch us in a few weeks' time for another episode of What's on Your Mind.